Hey guys, it's that Dividend guy coming at you with another dividend investing video. Hopefully everybody had a great day in the market. You know I always wish the best for my viewers and subscribers. So let's take a look today at the overall portfolio, how we did in the market, the individual holdings and how my stocks performed on a case-by-case basis. And then let's take a look at my watch list because I made some changes. I know I do make a lot of changes to the watch list. I only do that because I want to make certain that I pick the right stocks, and I usually try to hold my stocks for life. Um, but before I pick and choose, I like to switch some out and I try to keep my options open. So if there are some switches to the watch list, that's just because I found some new investments. I'm always looking for something new, and I found one that I really like. So let's take a look at the overall portfolio for today. So we are down today about 130 bucks. For the week, we're up 196. For the month, we're up 454. The 3 month mark, we're up 1700. For the year, we're up 2300. And all time, since April 13th of 2018, we're up about 19 or almost $2,000 at 9.62%. So not too bad considering that I've been out of work for about a month and a half and I was not able to put the 1,000 in the market like I want to. Still good growth. Can't really complain, especially because I've only been reinvesting dividends and not putting the 1,000 in the market like I plan to. Next, let's go to the individual holdings. Starting off with a dividend aristocrat in Realty Income, we have 15 shares. Market value is 915.15. Our average cost is 45.38. About 4.08%, so about 4% of the portfolio is in O stock. That will be going up. I'm a huge fan of this REIT. It's a monthly dividend paying stock, so this is a reoccurring payment, pays me every single month of the year, and I really do like that. I'm a fan of this of that company for that reason. And apparently they do quarterly. They try to do quarterly raises instead of yearly, which is phenomenal. Which means every quarter I get a little bit of a bump up if history repeats itself. So as of today, I'm up $14.46 on or $14.40 on 15 shares, up about 1.6%. Total, we're up 234.45 or 34.44% all time on Realty Income. Next, we have a Dividend King in Altria. We have 148 shares. Market value is $6,400. Average cost is $43.84. We're at 28.7% of the portfolio is in Altria Group. That's going to go way down because I'm going to be focused on Coca-Cola for a while. So I don't really like individual holdings having double digit, like that big of a double digit um, percentage of the portfolio. But it is a dividend king. It does pay a good dividend for the price. I mean, they're pretty diversified, and they're going into different categories instead of just tobacco. So I do like the company. I just want it to be the less of the portfolio, but I'm not going to sell any off. I'm just going to build up bigger positions or build up individual positions outside of this to make that percentage lower. So it's not really about minimizing this position. It's about growing other positions to the same size as this one. So today we're down $22.20. Total we're down 50.42, down about 0.8% on Altria, which is fine. It's a dividend king. I'm dividend efficient in this stock. It pays me about 120 some dollars every time I get paid, which is enough to buy 3 shares of this or 3 shares of the next company, which is Coca-Cola, another dividend king. I'm a bigger fan of Coca-Cola than I am of Altria because I'm a huge Coca-Cola fan. I love Coca-Cola. It's actually the first stock I ever bought. And this is the next stock that I'm planning on being dividend efficient in for this set of months. So let's take a look at Coca-Cola. We are sitting at 20 shares, market value of about 950 bucks. Average cost is 51.26, so we're down a bit on Coca-Cola, which is great. It's good news for me. 4.2% of the portfolio is in Coca-Cola. This is one of those that I wouldn't mind being at 8 to 10% of the portfolio because I'm a big fan of Coca-Cola. Today we're down 40 cents. Total, we're down 78.30, down 7.64%, but I'm okay with that because I love the cost down average opportunity that I get with Coca-Cola. And the story with Coca-Cola now is it's going to be my main focus for the set of months. So regardless of the price, if I keep buying it, it takes about 5 grand to be dividend efficient in this stock around my average cost. So the goal is to get $5,000 in the stock, be dividend efficient in Coca-Cola, so I can automatically buy another share of it every time that it pays me. And on top of that, Altria will be dividends will be poured into the stock as well. So Altria is going to be used as a hedge to buy more Coca-Cola. So when Altria pays me 120 bucks, that's going to get me like 2.5 shares of Coca-Cola. Once Coca-Cola is dividend efficient, then I'll be able to buy nearly 4 shares of Coca-Cola every single time I get paid. Plus, I will be adding 1,000. Once I'm back to work, I'll be adding $1,000 to Coca-Cola. So, according to my estimations, I should be dividend efficient in Coca-Cola by the time Christmas hits next year, as long as I get a job before the end of next month, which is the goal, depending on when my PT clears me. But that's the goal. For this set of months, Coca-Cola is going to be my main focus stock because I want to be dividend efficient in my favorite dividend king. Next, we have FRT, a dividend king as well. 1 share, market value is $80 and some change. Average cost is $113.40. 0.36% of the portfolio is in FRT, up 237 today, or 3%. Total, we're down 32.89. We're down 29% on FRT, but I'm not worried about that because I was smart and I only bought 1 share, which means that even if I spend, say I buy 12 to 15 shares of Coca-Cola, um, I can still put some money into this as well. So like, let's say um, I put I have an X amount of Coca-Cola shares I want to buy every month, right, with my $1,000. If I have spare change or excuse me, spare money, or if I have money left over from the month prior, I can put it into FRT and not really worry about it. And I do love FRT. It is a mall REIT, but it owns grocery, um, kind of grocer centered malls, so I'm more comfortable with it. And it is the only REIT that is a dividend king, so I love the REIT. I just don't have enough cash in it. I don't have enough cash right now in it, and it's not going to be my main focus for this set of months, but eventually it will be a pretty big contributor to the portfolio dividend wise. Then we're on to the next set of stock, or next month set of stocks being Lowe's. It is a dividend king. We have 2 shares, about $317 of market value. Our average cost is $100.86. It's 1.4% of the portfolio. I'm a big fan of Lowe's. They're up huge. They had a blowout earnings report, which I'm excited about, but I'm also kind of salty because I want to buy more Lowe's. And that's the same story with Target as well, actually. As of late, I'm up 60 cents today, up 115.44, or up 57% on Lowe's stock. Then we have my personal favorite for this set of months in AT&T stock. They're Dividend Aristocrat. I have 71 shares. I believe this one is dividend efficient at like 67 shares, so I'm more than dividend efficient at my cost basis. But this one is going to be the one that I pour money into. So like I said, Coca-Cola is the main focus. AT&T is going to be the main focus for this set of months because I want to be able to buy, 3 to 5 shares every single time this pays me. So once I get back to work, the main focus for the first set of months is Coca-Cola. The main focus for the second set of months is AT&T. And this is one of my personal favorites because they have a great telecom business. They just launched HBO Max and they have Warner assets. So I'm a huge, huge fan of this company. 71 shares. I am dividend efficient. $2,100 of market value. The average cost is $30.93. About 9.4% of the portfolio is in AT&T. Today we're down 71 cents. Total we're down 85.65, or we're down about 4% on AT&T, which I'm comfortable with because if you're a long time watcher, you will know that I was very irritated with the stock in from September to early March because it climbed up to like $38 and I didn't want to boost my average cost up by that much, so I just didn't buy it on that set of months, and I bought stuff like AbbVie, Lowe's, and looked for other investments as well because my darling AT&T decided to shoot up. So now I'm not as irritated. It's at a good cost right now, and I can put more money into it. So happy about AT&T, and that will be the stock that I select for this set of months. And just like I said with Coca-Cola for last set of months, for the last set of months, just because it's my focus does not mean it's going to be the only stock that I purchase. So if I have extra cash and I have enough to say to buy AbbVie or say Colgate or something like that, I will put the money in there. I just have a select number of shares I need to buy in order to be dividend efficient in the stock by the end of next year. Um, Next, we have AbbVie, a Dividend Aristocrat. We have 60 shares. 5712 is our market value. Average cost is 72.22. 25% of the portfolio is in AbbVie. That's way too high. That will be going down. We're down $54 today, up 13, almost $1,400 all time, up 31.81 for AbbVie. And from here on out, AbbVie's dividend, like I said with Altria, will Altria's dividend is going into Coca-Cola. AbbVie's dividend is going into AT&T for two reasons. One, AT&T is going to be my focus stock, but two, because AbbVie's at $95 a share, and I only make 70.80, so I don't actually have enough to be dividend efficient. But I at these prices, but I did at my average cost. It was $2 off, and with Lowe's dividend and O's dividend, I was covered to have another share of AbbVie, but not at these prices. Next, we have Target, we're at 36912. This is just like Lowe's, same situation. They blew out earnings. They even beat Walmart in same-store sales, which is crazy. They are Dividend King, and I'm proud to own them. I have 10 shares. Market value is $1,500. Average cost is $87.68. Today, Target makes up about 7% of the portfolio. Today, we're down $17.30. Total, we're up $648.12, or up 73% on Target. And they are paying me a dividend September 10th of $6.80, which is nice. Then we have J&J, Dividend King. 2 shares, $300 of market value. Average cost is $135.79. 1.3% of the portfolio is in J&J. We're up $234 today, up $31.54 total, up about 11.6%. They have not announced their dividend yet, but they will soon. Next, we have 3M, a Dividend King. 2 shares, 325 is our market value. Our average cost is $147.28. Portfolio value is 1.4%. Today, we're down about $3. Total, we're up $30.47, up 10% on 3M. Then we have Walgreens. They're close to Dividend King status, but not quite, so they're an aristocrat. 6 shares, market value is $238.56. Average cost is $39.92, so we're down a little bit. It's 1.06% of the portfolio. Today, we're down about $3. Total, we're down about 93 cents. And they are paying me a dividend of $2.81 for my 6 shares. Then we have ExxonMobil, Dividend Aristocrat. We have 84 shares. Sorry about that, YouTube notification. 84 shares. Market value is $3,400. Average cost is $53.20. 15% of the portfolio is in ExxonMobil. That will be going down again, not by selling out of the position, but by boosting up other stocks in this same pay period. Today, we're down about $50. Total, we're down about 1,000, which I'm okay with that. They're a Dividend Aristocrat. They've grown their dividend for, I think, 36 years. So I'm okay with holding nearly 100 shares because the more shares you hold of a company, the more you get when they increase the dividend. And I do realize that Altria, AbbVie, and ExxonMobil are all above 15% of the portfolio, and I'm comfortable with that, but that will be changing because like I said, I'm going to be buying a lot of Coca-Cola, a lot of AT&T, and a lot of another stock that I'll show you later. Being this one, Aflac. This is my pick for the third set of months because it only takes about $4,600 to be dividend efficient at around $37 or $38. So that will be my pick for the third set of months. So it's going to be it's going to be Altria feeding into Coca-Cola, it's going to be AbbVie feeding into AT&T, and it's going to be Exxon feeding into Aflac. So I'm using the interest of my other investments to feed into the ones that I'm trying to become dividend efficient in. And this way, by the end of next year, I will be dividend efficient in 3 more stocks, which is phenomenal. So I'll be getting a share of I can buy 3 shares or 2 shares of Altria, 2 shares of Coca-Cola. I'll be able to get 3 shares of AT&T, or excuse me, 4 shares of AT&T because I can buy 3 now. So 4 shares of AT&T, and then I'll be able to get 3 shares of Aflac as well between the stocks that are already paying me dividends and I'm efficient in, plus the ones I want to be efficient in. So I'll be able to buy 3 shares of all of these companies, which is phenomenal. Which is the goal, is to use your money to make more money. So I have 1 share. Market value is $36.66. Average cost is $35.75. 0.1. Excuse me. 0.16% of the portfolio is in Aflac, down 37 cents today, down 1%. Total, we're up 91 cents. or $2 or 2.55%. They do pay a dividend of 28 cents per share. That's why I'm only getting 28 cents because I only have one share. But that will be changing because this stock, Aflac's going to be a huge focus, and I love insurance. Next, we have Leggett & Platt, and for the watch list, I'm just going to be telling you whether or not I buy the stock at this current price. So around 40 bucks. To me, it is a buy because I have about $15 of upside, which is the minimum I have, or minimum I need to buy stock is $15 of upside per share. Then Cisco at 57 at 85, it's nearly $20 of upside, so I'm definitely buying it there. Genuine Parts at 92.22, not quite enough, but I would buy it because of the king status. It's close enough. I would initiate a small position in Genuine Parts, and I'd wait for it to fall a little bit more to really bump up the number of shares to take advantage of a lower price per share. Then PepsiCo at 136, not about $11 of upside, not quite enough for me to purchase it. So I'm passing on Pepsi at these levels. Kimberly-Clark at 157, I'm not touching it. It's $3 below its 52-week high. I would need it to be around $140, $142 to $145 in order to comfortably buy Kimberly-Clark. Then we have Starbucks onto the next set of months. I like Starbucks. I know it's not a status stock, but they have risen their dividend quite well year over year. They're not a status stock, so they haven't paid for uh, a large number of years, as in, like, they don't have a large streak. They're not an aristocrat, but their percentage year over year is enough that it caught my attention, and it kind of let me violate my rule because the fact that the percentage boost is so good year over year that I want that in my portfolio. So at 77.20, definitely a buy, about $20 of upside per share. Then Colgate, a dividend king at 78. It's too close to its 52-week high, but since it's $78, just like I said with Genuine Parts, I would initiate a position that I could replicate, as in if I have $1,000 and I put 500 in to Colgate, buy about 5 or 6 shares, I could easily reciprocate or easily mirror that purchase because I only put a certain number in. But if I put in half my cash for the month into Colgate, put the other half into, say, something like AT&T, I could easily replicate that purchase next month and not have to worry about it if the price goes down. Then Procter & Gamble at 136, just like I said with Colgate, it's pretty close to its 52-week high, but if I were to initiate a position, I'd make it small enough that I could replicate it the next month and buy the same number of shares as long as the share price was lower than the initial purchase price. Then Caterpillar at 137, definitely buying it here, just enough upside that I'm comfortable buying the stock. Then Essex Property, anything at or below 300 is phenomenal. Actually, I would be willing to buy it at 310, about with $14 of upside, but below 300 is a steal. Black Hills, so I switched them out for Edison, Consolidated Edison, because they're close to Dividend King status. They don't have quite as long of a dividend increase history as Consolidated Edison, but the reason I liked them is because they list a lot of states for their not only their utility and gas play, so they do a little bit more than Consolidated Edison, but they're in the Midwest of the United States, which is where I actually live, versus picking a stock that powers New York City. I'd rather have one that powers where I live and the states surrounding it. It makes me feel more comfortable having more states listed because that's a wider spread, and they do more than just electricity. They do gas and mining and other things like that as well. So I'm a little bit more comfortable with Black Hills. But at $57 a share, it's definitely a buy because its 52-week high is 87. So I have nearly $30 of upside per share, plus I believe a 53-cent dividend. So a lot. I think it's up to like 45 years of, or 43, 45, something like that, years of consecutive dividend growth. So not only do I get a $30 upside on the stock, I get a phenomenal dividend increase history and a little bit more diversification than the other pick that I had prior to this one. Then McDonald's, one of my real estate plays at 209. I would definitely buy it because I'm a fan of McDonald's and I want more real estate, but I do want to buy it, but at these prices, I wouldn't touch it. Not enough upside. This one is newer, so I believe I switched them out for Tesla, which I might put Tesla back I did warn you that I made a switch. Warner Music Group actually uh, just IPO'd not too long ago. I was looking up stuff for Airbnb and I came across this stock. So the reason that I want to buy this is because they broke off from Warner, which I actually own. They're an independent company, like an independent record label. I love music. I know the industry. I've put music on Spotify, stuff like that. But they have such a wide array of artists. Ones from like Ed Sheeran, T.I., P. Diddy, Led Zeppelin, the Rolling Stones, Frank Sinatra. They've got so many iconic art. Metallica, um, Pantera. They have a lot of really good acts signed to Warner Music Group, and they don't pay a dividend, so they're a growth stock. So this would be a growth play. They're pretty new to Robinhood, otherwise they wouldn't be in that category. But Warner Music Group engages in publishing and recording music. It operates through the record music and music production segments. The recorded music segment involves selling, marketing, distributing, and licensing of recorded music produced by the company's recording artists. The music publishing segment acts as a copyright owner and/or administrator of the musical compositions. It generates revenues related to the exploration of musical compositions. The company was founded November 21st, 2003, and is headquartered in New York. The listed name of WMG is Warner Music Group, Class A common stock. So I named some of the people that they have signed. Um, Honestly, for me personally, Ed Sheeran is enough to buy this stock. I'm such a fanboy. But then you get Frank Sinatra, you get Pantera's catalog, you get Prince's catalog as well. Just such a wide array of artists. I think this stock has some very good growth potential considering that it just came on the market, what, a few months ago? Yeah. It's been on the market for, what, a month? Yeah, something like that. So it's relatively new to the market, which I usually don't mess with IPOs. But given that I love the music industry and I love a lot of I listed a lot of the talent that they own, that they have signed to their label and the music that they actually own copyrights to, I wanted in my portfolio. So I did get rid of Tesla, but I might bring it back. The issue is I only have four growth stocks right now. Warner Music is the newest one because, like I said, I wanted to find a way to invest in something like Interscope, who owns Eminem in his catalog. The only way I found that I could invest in them is through a Chinese company, which I didn't want to do because want I want to be like a homegrown kid, want to invest in specific U.S. stocks. But I am a huge fan of a lot of the artists here, so I would take pride in owning this stock because I'm a fan of a lot of the talent that they own. Next is Apple. Um, I don't really need an explanation here. They are a world class company. I use a lot of their product line. Um, I love the ecosystem, and the main reason I want it is the service sector because I think the services sector is going to blow up. I think it's going to be their leading, one day it will be their leading profit profitability sector, and I don't think they'll be as reliant on iPhones. But I'm a big fan of Apple, and I really want to own Apple. Next is Disney. I've owned it before. I sold it because it didn't fit my dividend discount model because it no longer paid a dividend because they slashed it because the parks were closed due to COVID. But I would be happy to own it as a growth play. So I want Disney back in my portfolio. I'm a big fan of Disney and a big fan of Warner, and the business is so diversified. I love it. I just sold it because I had profit on the table and they cut their dividend. But now I want it back in the portfolio. I kind of regret selling it, but you live and you learn. I use the profits from Disney to pour it into use the profits from Disney to pour it into Walgreens stock, and that's paying me now, so I get passive income from that versus the money just sitting, being locked in Disney. Originally, it didn't fit the purpose of the portfolio, but now that I kind of want to add more growth in, I think Disney's a great growth play. Then we have Facebook. I think it's phenomenal. I love Facebook. I love Zuckerberg. I love the ad revenue from this and the user base and the fact that they have a lot of other um, monetizable apps that they have not used, like as in WhatsApp. They don't have advertisements on Messenger. Um, I think it's a profitable company, but I think it could be even more profitable. So I'm a huge fan of Facebook, and I'll own it someday. And then, so I did get rid of Tesla, but I do want it. I'm not sure which one to get rid of. If I was going to cut one for Tesla, it would actually probably end up being Facebook, even though I'm a big fan of it. But the reason I only have four, as you can count, so two, three, four, is because I actually want a real estate growth stock, and I'm thinking I want it to be Airbnb. So this way, I get the social media side, I get the Disney Entertainment theme park cruise lines, I get the Apple, the beast that is Apple, and I also get a music stock because I'm a huge fan of music. But I do really want Tesla, so I might go ahead and get rid of a dividend stock that I'm not as excited about in order to get a sixth growth spot play because I found Warner today and I do really want to own them because as I explained, they own a lot of the artists' music that I like. Apple, I don't want to get rid of. I'm a fanboy of Apple. I've been a huge supporter of Apple by buying their products my entire life. Disney, I've been a fan since I was two, as has like 90% of America. Facebook is an app I use every single day. I'm loyal to Zuckerberg. I think he's a phenomenal visionary, and the fact that they own Instagram makes it even more viable. And the fact that they have platforms that they haven't monetized yet, and then Airbnb because I want a real estate play. So, anyways, guys, that will wrap up the overall portfolio. And I think I will delete a dividend stock to get Tesla in the portfolio because I am a big Tesla fan as well. So, anyways, guys, that wraps it up today. I was super excited about the Warner growth stock pick. So, thank you guys so much for watching. Remember to subscribe, hit the big red button for that dividend guy on my YouTube channel. When you do, hit the bell notification so you don't miss any updates. I post YouTube videos on my portfolio every single day, Monday through Friday, and I also try to throw in like Tesla news, news about my individual holdings. I update on Warren Buffett's portfolio, and I'm trying to do some stock IPOs as well. So I will be doing a video on Airbnb here pretty quick because I'm a huge fan, and as I said, I do want a growth stock real estate play. And I think Airbnb is going to fit that perfectly. So, anyways, guys, I'll see you tomorrow with another dividend investing video. Take care, guys.